Good afternoon, everyone. Welcome to Pharma Business Forum. I am so excited to be part of this discussion to unearth some of the challenges pharma business face due to funding. I trust this is going to be an interesting discussion. My name is Kate Quinn-Folson, and I'll be your host for this event. There are several challenges businesses face, and key among them is the funding challenge. One of the biggest challenges in our part of the world is collateral to serve as security, and banks are unwilling to grant loans to startup capital. I'm privileged to have in my midst Mr. Samuel Donko.
Thank you.
And then we have Mr. James Orakatete. And then we have Mr. Anthony Owusu Anan. And then last but not the least, we have Mr. Daniel Ewuzi Odum. Gentlemen, you're all welcome to the show.
Thank you very much. Thank you.
To our audience joining us virtually, we welcome all your questions and contributions. Thank you. Let's get started on the theme, innovative and non-traditional funding solution for pharma businesses. And Mr. Samuel Donko will be speaking on the subject, classical funding challenges in pharma business. So the floor is yours.
Classical funding challenges for the pharmaceutical sector. Yeah, that's a very broad topic indeed. But let me start off by taking viewers through what I will call the pharmaceutical chain. Others may also call it the road of the pharmaceutical sales. So that will put things in proper perspective for most of our members. Yes. First of all, for pharmaceutical products usually come from manufacturers. And from the manufacturer, either it's locally manufactured or it's coming from an externally manufactured product, which means the product is being imported into their country. So they will export and it gets to the importer. From the importer or the locally manufactured, it gets to the wholesaler. From the wholesaler, it ends up with the retailer. The retailer now sells to the public. Sometimes through the route, it also moves from the wholesaler's end and it gets to the hospitals and the clinics, the various pharmacy departments, where it is also made available to the patients or the consumers. So when we are talking about the supply chain, we should get it that we are looking at importers, manufacturers, wholesalers, retailers, or hospital outlets. That's the way we put it. So what are the challenges? I'm sure looking at the chain that we described, I would want to practically start this discussion by looking at the classical challenges that will be faced by a typical pharmaceutical retail sectors. Because the retail sector seems to be the end point for which the product would eventually get to the final consumer. So what are the challenges that we have with the pharmaceutical retail sector? I'll tell my little story about pharmaceutical retail back in 1997 when I started pharmaceutical retail business. How did I go about it? Out of my savings, out of some funds I had, I could go in and rent a shop space. Having rented a shop space, you go through the pharmacy council, get a license approved. You put your shelves, everything in place. That is where probably your own capital will end you. But we had an industry or a sector where traditionally we depend on wholesalers or suppliers for credit. So the pharmaceutical sector has been known traditionally that when you're in the retail sector, you need to fall on the wholesaler, the importers, or the manufacturers, get the goods on credit, then you intend to sell. If you take that into consideration, then what it means is that the business at the retail end is actually being funded from your own capital, which will be your equity, and that of the wholesalers and retailers have been funding the industry for so long. So how do you then address the retailers pay the wholesalers or the manufacturers or the importers? Then comes what we usually have in the industry as post-dated checks. So based on a certain trend of sales you have, you anticipate that next month I'm going to make sales of this value. The following month I'll make sales of this value. You do the purchases, then you give post-dated checks. And I think that has been a classical challenge for the industry. You anticipate the sales, you write post-dated checks against it. Something happens, the sales do not go as anticipated, then you start having these checks being returned. Or we use the term in the industry, bounce checks. These checks start to bounce. I've had an opportunity to visit a retailer or a wholesaler and importer who had stack of. So the question one will ask is, why do retailers or the community pharmacists rely so much on credit from the importers and wholesalers, not from traditional funding, not from the financial institutions? The answer is simple. When they go to the financial institutions, at the interest rate that they will be charged, let's assume that you are even giving the loan for 30%. That comes to 2.5% per month. 2.5% per month. If he's going to hold credit for 3 months, you multiply that to 7.5% extra cost to him. If I can get a supplier to give me products virtually at no extra cost, at no funding cost, for 2 to 3 months for me to pay, why go to a traditional financial institution to go and pay that? Don't forget that times back, we used to pay about 48% interest rate, which translates to 4% per month. So just multiply that. So the industry, which is the retail sector, that we need to look into funding. And that is where, if the funding is done appropriately, it would have the ripple effect on the importers and the wholesalers. Then eventually get to also get to the manufacturers. It's where we have a basic problem. The retail sector, it is not adequately funded. And most of them depends on the funding from the suppliers, which is the wholesalers or the importers.
So next on my list is Mr. James Orakatete from Fidelity Bank. He will be speaking on the topic, classical funding models for pharma business. Sir, the floor is yours.
Okay, now let me pick the conversation from where my colleague started, and thank you for the question, and thank you for the introduction. Now, just a brief background. Banks, as we all know, are, let's say, aggregator of funds. So we source our funds from deposited funds and other sources. And then basically, it's like mopping up from those who have excess, and then on lending to businesses that would need it. What that basically means is the funds will have to be made available to those deposited whenever they want it. And so we need to be careful on how we handle those funds. Now, what it also means is, for us, we need to be able to understand the dynamics of the various sectors we deal with, so that we understand how, as he said, their cycles are, when they sell, how long it will take them to get those monies back, and how they will even get those monies back. I mean, we appreciate the fact that the health sector and the pharmacy business would need some level of funding. And for us as a Ghanaian bank, that is also dear to our hearts, because we are a Ghanaian bank, and whatever happening in the Ghanaian economy, I think is something we need to be concerned about. So aside that, we know they need funding for what? Sometimes working capital support, sometimes to buy equipment, and a whole lot of things that they will need the funding for. From where we sit and from where our experience, we've actually looked at various lending models. I mean, these are models that we've experienced, and based on that, we've been able to arrive at something that really we believe works for the pharmacy industry, at least. Now, basically, it's also important that whatever products or solutions we come up with, we make sure we do the necessary research, because the whole essence of a solution or a lending product is for it to be able to meet the needs of the people or the businesses we are giving it to. Otherwise, what's the point? You know, so we are very, very, very customer-centric in terms of how we start some of these things, to be able to understand what is happening in that sector or that business, so we can structure something appropriately. Now, in terms of the various funding models, I'll start by saying, just as I said, banks traditionally would aggregate funds and lend out. So the first model obviously will be where the bank itself uses its own funds to lend to these institutions. Now, as I said before, it is important that we understand the dynamics of these sectors, because remember, these are people's monies, so that when we lend them out, we will be able to, get these monies back and then give it to them as and when they want it. Now, in terms of rates, as he just said, there are a lot of factors that would influence the rates, and that I will not go into too much. But the first model I'll say is banks lending directly with its own funds. Now,
Okay, so James, when it comes to pharma companies, what do banks normally look out for in lending money in lending to them?
well, in terms of what we look out for, I was going to address the models so that when I finish the models, maybe I can look at that aspect of what we look out for. But basically, so the first model, as I said, is where the banks itself uses its own funds. Now, another model would be where we enter into, let's say, a hybrid form of lending, where we collaborate with other DFIs, the development financing institutions, who are also eager to promote business in certain sectors. And so once you collaborate, what will happen is you co-fund using both parties' funds, and then try and drive business in that sector. Now, that arrangement can always have an impact on interest rates because, fine, the bank is sourcing its own funding from somewhere. The DFI is also bringing funding from somewhere. Now, if that funding source from the DFI is at a lower rate, you can always dilute, and it always has an impact on the interest rate. In terms of risk, it also lowers the bank's risk in the sense that for some of these DFIs, they are specialists in those sectors that they want to drive in. And so once the two of you have something in common in that sector, what it means is there's expertise, there's technical assistance. So it's not just a matter of throwing money out there, but there's the expertise to go with that to support the business so that we're ensuring that whatever structures that need to be put in place, whatever hand-holding that has to be put in place is actually put in place to ensure the business will be successful, all things being equal. So I'll say the second one is the hybrid model. Now, there's a third one that I'll say is the guarantee funding model, where, for example, it's also a matter of we have another institution who is ready to absorb some of the risk in that sector. So they are collaborating with you to be able to absorb some of the risk so that we can lend to that sector. So the objective of all these is to try and drive business in particular sectors, really. That works well for both parties, really. So those are the clear funding models that I wanted to talk about. Now, in terms of what we look out for, there are a number of factors we look out for. I am sure a lot of people would say for banks, all they look out for is the collateral. But really, collateral is the last thing on our minds. As somebody would say, in quotes, forgive my language, we are not a real estate company. So it is not our interest to be foreclosing on people's properties. That's not objective.
But without collateral, you don't secure facilities.
Pardon?
Without collateral, you don't grant facilities.
No, that is also a wrong perception. Now, for us, the first thing we look at is the ability to be able to repay. Because as I said, these are people's monies that we are lending. And for us to lend it, we need to be sure that you can repay. So there are certain things we'll ask for. Those things are all with the objective of trying to assess your ability to repay the monies you're asking for. So the financials we ask for, the cash flow we ask for, some of these things are just to be able to assess your ability to repay.
But people can cook that.
Yes, we know. We know sometimes people can do that. But there are various ways we can look at these things, and we know when somebody is cooking. I mean, the second thing we would also look at, aside the ability, is the willingness. And willingness can be explained through a lot of ways, for example. Now, the willingness can be seen from, first of all, the people behind the business. Are they people who have a history of not wanting to pay facilities when they take one? What is their demeanor when it comes to meeting regulatory requirements? Because remember, when it comes to the pharmacy business, there are certain requirements we are supposed to meet. You understand? So that is also an aspect we would like to look at. Now, before you come to borrow from me, remember the business is yours. You set up the business. How much money have you put in? Because you need to be able to believe in what you are doing, to put in a substantial amount of money as investments in the business, so that my money from the bank is just supporting you to meet your objective. So it shouldn't be the case that you are relying on the bank's money to fund everything. So we will look at that as well. So for us, I think that, as I said, the main thing we'll look at really is your ability to repay, and then your willingness. These are very two critical things that we look at, all tied into the other things that I've also mentioned.
So we have Mr. Antonio Uswanan, who will be speaking on the subject, private equity and partnership in pharma business.
Let me start off from where my other colleague panelists ended, and then also to kind of piggyback on what Mr. Donko said earlier on. Just like Mr. Donko was talking about the value chain in the pharma business, in the financing business, there's also a value chain of financing, if you want to put it that way. And the typical value chain of financing can be likened to life in itself. So you think of it as a baby that comes from conception and then is born into life, grows and dies. So you can think of what my colleague here was talking about, that you made mention that people will say that banks do not finance startups. It's just for the simple reason is that they are not structured nor are they positioned to support startups. And I'll use the life cycle analogy to kind of explain it. So when an idea comes into somebody's head to start a business, it is like a woman getting pregnant. It's a seed. So that seed gets incubated in the mother's womb, right? So businesses will go through the same thing. You get an idea in your head, then the idea has to go through some kind of incubation, some kind of process. Then after incubation, you're giving birth. So that is when basically the business is now established, it's opened an office, and it's about to start its life. But when the business starts its life, it's like a toddler. And a toddler must be given baby food. So if you go to a bank and tell the bank to give startup money, it's like trying to give food to a toddler. It just doesn't fit. So there are other forms of financing and support that is typically appropriate for a toddler. So in the financing world, the same analogy applies. Then the baby begins to grow very fast. And then when he begins to grow, there is also a different type of food that you need to give that baby. So again, in the financing world, there is, a class of financing institutions who provide food to that business or baby within that stage. Then the baby becomes, a strong young man who now knows what time it is. Let's put it that way. And that is when my fellow friend here will come in. So they will be looking for businesses who are now young men, well-educated, they know what they are doing, they are earning their income, their cash flows are predictable, so that when he gives that person a loan, to a larger degree, he can predict what will be the outcome of that business. So my industry, which people would typically call the private equity or venture capital industry, we typically will look at the baby from the time he was born to the time he becomes an adolescent who is running. And then when he becomes a strong man, we hand him over to our fellow bankers to take them on. So if you look at that value chain, initially you have what we call incubators. And what the incubators do is basically, just like I described with the conception analogy, they incubate businesses. So at this point, it's not about you need money and an interest rate of this and that. It's about what is your needs, what is appropriate for you, and how can we assist you so that you get born in the first place. Then once that you are born, at the toddler level where you are beginning to go up, then we come to what we call accelerators. So accelerators are saying, okay, the business has been born, it's got a year or two under life, but we need to accelerate what? Its growth. So the accelerators will do their job. Then when they are done, they will hand them over to the likes of me, which we call the VC or venture capital industry, and to a larger degree, the private equity industry. We then take that business, we fix it We grow it to the point where they are now strong enough to eat fufu, then we hand them over to...
So say, what's the difference between private equity and banking?
The difference between private equity and banking can be described just like I have described in the life cycle stage. That where we normally focus at the stage of the business's life cycle can be different. We focus mostly on the early stages of the business's life cycle as opposed to the matured stages of the business's life cycle. And the reason is that equity or private equity or venture capitalists, we don't give loans. We provide equity. So, i.e., we become your partner. Our funding is not a transactional funding where we give you money and say 2 years, come and give us back our money. We give you money and we become your partner. So if I'm going to give you money and I want to be your partner, I want to come in at the point where you have potential for growth. I don't want to come in when you're already matured, you know your way of life, and you can tell me what you want. At that point, fidelity will be very nice for you. But I want to come in where you're still trying to figure out what to do. And I can, through my own assessment, understand that you have the potential what? For growth. So the difference is that we're looking for growth, we're looking for innovation, and we provide financing which is not a loan. Financing that makes us partners of the business. Now, a lot of people normally get apprehensions when they hear about private equity people saying that they take partnerships. But our partnerships, to a larger degree, I liken it to a marriage with a divorce date. Every private equity guy will enter a business and will tell you the date in which he will divorce you. So we come in and typically between 5 to 7 years, we are out. So our funding is also long-term. So we have patience, we build with you, we make you bigger than you were before, then we exit. He also did make mention of banks getting their sources of funding from deposits. Now, a deposit in a bank is what you call a demand deposit. So somebody walks into the bank, he wants his money, you have to give him back his money. So what that means that they cannot go very long because there's always demand on their cash from depositors. The money that we use typically comes from what we call sophisticated investors. So they will give us money for 10 years. Sometimes they add 2 more years to 12 years. So we have 12 years to invest the money without somebody coming back for what? For the money. Whereas they, on a daily basis, people are demanding their money. So typically they will do maximum 3 years or worst case scenario 5.
Yes, it's long term.
Exactly. But we could do 5 years, we could do 7 years, we could do 7 years. So there are different things that we do differently based on how we are positioned.
So what do private equity investors look out for in making a decision to partner someone in pharma business or any other business?
Okay. So as I was saying, we don't do interest rate. We go in when you are young, and let's say if your business is worth 100 cedis today, we want to grow it to be 500 cedis in the next 5 years. So we look for businesses that have potential to grow or scale. So that when we put in that 1 cedi, 5 years from now, we can take out 5 cedis. So we don't talk interest rate. We talk return on what? Investment. And the return on investment we want is the same return as the promoter wants. Because remember, we are partners. So if we are partners, why should you get more than I do? We should get the same based on our what? Percentage equity in the business. So the key thing we look for is the potential for growth. That's the first thing we are looking for. Now, in doing so, we also ask ourselves, let's say it's a retail pharmacy shop. There are so many retail pharmacy shops in Ghana. So if my friend here comes to me and says he's looking for private equity funding for his retail pharmacy shop, the question I'm going to ask myself is, why you? What makes you different? Can I make you a game changer? If everybody is growing at 2x, can I grow you at 5x? So those are the type of questions I'm going to ask myself. What is so innovative about what he's doing? What makes him stand out for me to be able to tap into that growth? So he did mention something about some of the challenges about their cash conversion cycle being 8 months. if he comes to me with a strategy and say, you know what, one of the key challenges in this industry is that cash conversion cycle is 8 months. But I've come up with some IT system that could do just-in-time inventory, or I have developed something innovative that can shorten that cash conversion cycle to say 6 months or 3 months. Then I'm like, okay, I want to go with you. I'm going to give you money. Let's implement those things and make sure that we can grow you 5 times X whilst everybody else is growing at what? 2 times X. So our funding is more solution-oriented, looking for challenges and looking for innovation solutions around that challenges that will allow the promoters that we back to grow faster than anybody else. The other key thing we look for is the character of the promoter, which my friend here also mentioned. Because our type of funding, like I said, is like a marriage. You don't go into marriage without knowing your partner.
So, sir, can you partner a startup business?
Yes, we can partner a startup business. But then we have to first know that the promoter is the right person to start that business. Because somebody says, okay, let's do cocoa and sell. Everybody can do cocoa and sell. So the question I'm asking is, why you? What makes you unique? Have you done cocoa before? Have you sold? Do you have some innovation solution for selling cocoa? Are you going to make something in your cocoa that will make you stand out? So whatever the promoter is bringing on board, be it his experience, be it his thought process, be it his relationship management and the ability to work for, we look for all those things before we make a decision. So to summarize it, I can say we look for 2 things in viability. What we call the business viability and innovation, and the entrepreneurial viability. If we can ascertain these 2 things, you are more likely to be our client.
We have Mr. Frank Redu from Ghana Cooperative Pharmacist Credit Union joining us online. Sir, you're welcome.
Thank you very much.
So now the turn of Mr. Derek Ewuzi Odom from Farm Access. I hope I had it correct.
Yes, you did. You got it correct.
He will be speaking on other innovating funding models for pharma business. So we would like to hear from you.
Okay, so thank you, Madam Moderator. Well, Farm Access is an organization that is set out to improve health systems so that no one is left behind when it comes to access to healthcare. And we try to do this by being innovative or using technology, because we believe that technology has the potential to revolutionize the healthcare system and bring more impact. And as part of the programs or the approaches to achieve this, Pharma Access set up what we call Medical Credit Fund. And Medical Credit Fund, I can say, is the only blended finance organization that is focused solely on health in Africa. And we operate currently from 5 countries: Kenya, Nigeria, Tanzania, Ghana, and also in Uganda. Now, so what we do really is to provide funding alternatives. And broadly, what we have 3 ways of doing this. The first is what we call partner lending. I'll just give brief explanation or exposition on these. And the second one is syndication, which is very known out there. And the third is what we have christened direct lending. And in Ghana, Medical Credit Fund has been working with partner banks or partner financial institutions. So we are mostly using our, our partner lending approach in providing financing to all players in the health value chain in the country. So you can talk of hospitals, clinics, pharmaceutical companies, that's manufacturers, importers, wholesalers, pharmacies, diagnosis centers, and all. But I guess that today our discussion is going to center mainly on pharma businesses. And I can tell you that we're currently in partnership with two mainstream banks in Ghana, universal banks, that's Fidelity Bank and Republic Bank. And we are providing typically term loans, overdraft, and we have also come up or designed innovative products that we call receivables financing. And here we actually discount receivables or claims from either the National Health Insurance, Authority, the claims from them, or even the private insurance companies in healthcare. And we pre-finance the claims so that you meet all your liquidity needs. You know, like my earlier colleagues mentioned, it takes quite a long time for businesses to get paid these claims, and therefore they have liquidity crunches. They are not able to really meet their short-term needs. And we come in with this product to ensure that you have funds available for your day-to-day operations, to meet payment of salaries, to purchase inventories, and to do everything that you want to do. Sometimes even to buy equipment, you know. So we are able to do this. Again, we are currently looking at coming up with a digital product, or we call it digital lending. We believe that the current situation where mobile penetration or mobile money penetration is so deep in Ghana. I mean, in Kenya has shown the way, and Ghana wants to follow suit. And we have a lot of people using mobile money, even in paying for services, including healthcare, and also purchasing drugs from pharmacies and here and there. And we think that, you know, lending can also be innovative, can be made easier, where you can also scale up easily, reach out to a lot of people, you know, and make more impact, because we are a development finance organization. We are set out, or we are set up to make impact, you know, in the lives of people. So mobile-based digital lending is something that we are looking at, and very soon, in a matter of weeks, maybe a month, we're coming up with a product or a funding approach where businesses can access credit and loans using their mobile wallets. They don't need to be physically present in the banks or go to anywhere. Just using their phones, they can access loans and pay very easily and very comfortably.
We have Mr. Frank Redu joining us online from Ghana Cooperative Pharmacists Credit Union. We would like to know, what role does Ghana Cooperative Pharmacists Credit Union play in funding pharma business?
Okay, so thank you and good evening to colleague panelists and then everybody watching us. I would say that the Cooperative Credit Union plays quite an important and a lot of role in supporting pharma business. To start with, I heard many talking about startup capital for pharmacies and things. It's on record that the Cooperative Pharmaceutical Credit Union has supported members in the startup of their businesses. This is true, and there are a lot of evidences to support that. By our model, the way we operate, so we can lend this support to the member pharmacist who is desirous of starting his business whilst also working elsewhere. And this has been done over the years. We also provide short to medium-term loans for pharmacies and pharmacy businesses. And this is by way that as a member of the credit union, you have access to a loan of up to 200,000 cedis for your business to support purchases of assets and other things that you may require. We also have the import support loans for pharma businesses. This is a quick access to 50,000 cedis that we grant to farmer businesses in order to support the clearing of their goods from the port. And these are available for members who are mainly pharmacists to make good use of. Currently, we are looking at moving into the acquisition of vehicle space. We realize that many pharmacists and small pharmacies may need some vehicle to help with the movement of their goods and also distribution. When you go to the banks usually will require a brand new car, which many small businesses find difficult financing or going with. So we are looking at how we can get a fairly used vehicle that can support these farmer businesses and will spread the repayment over time. So when it comes to support for farmer business, the credit union, since its inception, has been in a very strategic position to support pharmacists and their farmer business. You know, when we talk of farmer business, majority of them are the pharmacies in the communities. And these are mainly the ones that we support. In recent times, we're also extending the support to small businesses for them to also take advantage. We know the credit union is mainly for pharmacists and its allied professionals in the medical space. And we also know that society is evolving. One unique position for the credit union is that it's made up of a number of members who are mainly pharmacists. So we understand the pharma business and we are colleagues. We operate on the different levels. Pharmacy, financing of business is also evolving. Risk is an issue, and many of the banks usually look at a lot of. I heard Kate mentioning collateral, whether if you don't have collateral, the banks will not lend to you. It may be true, but in the credit union spaces, you don't insist on collateral. In fact, we don't ask of collateral. It's a self-guarantee where a member guarantees the loans that you are taking. Just a little insight. Realize that society is changing or evolving. Now the teachers have their teachers fund. I hear the military also have a certain funds that they give to their personnel. So GCPCUL is a finance arm. I prefer to call it the pharmacist bank. It's a finance arm of pharmacists and pharmacist business. And once we turn our eyes to that place, I'm sure it can really help us to grow. And once we know ourselves, then the issue of risk is minimized and the issue of collateral can also be waived off. So what is a credit union? Just for a brief, for my colleagues who may not be aware, the credit union is a member-owned and member-controlled. Before you can access any funds, you need to apply to become a member. You need to buy shares in the union. And with the minimum of 300 cedis, you can buy the shares and be a part owner of the company, if I want to put it that way. And it is a member-controlled because at the AGM, then we now elect the members who we want them to run the affairs of the union for a period of 4 years. So if the sort of managers or directors are not managing them well, then of course we have the options to kick them out, so to say, so that new managers now come on board. So once it's a member-owned and a member-controlled institution, decision-making is also decentralized. As a member of the credit union, you are part of the decision-making and strategic direction of the business. And this is done by the majority shareholders at the AGM.
So in conclusion, if any of you have something to say before.
Yeah, maybe a few words. I might say, as I said, we started from somewhere, we've made huge progress. And the health sector in general is a sector that's been dear to our hearts. And the pharmacy side of things, I mean, is no exception. And clearly it is telling in our books, as I said earlier. It's been a learning curve as well in this engagement. And there are a few things that we'll take on board as we leave here. And for me, at least, it was very, very refreshing when, as I said, he referred to certain things that I realized that, okay, there's something happening that is good, that probably will have a huge impact on the pharmacy or pharma businesses. So in all, it's been a good session. There are a few things, as I said, we've picked. And I know we've made huge progress, but there's still a lot out there that we can do to support the sector. And it's something that we will continue to do. With that assurance, I'll give you something that we'll continue to do. I mean, outside this forum too, anybody who wants to have further engagements, I think we are open to that. I gave my number out. I don't know if we can give that out, again. But we are available for further engagements after here. So just a few things.
Maybe I also want to thank you guys for putting together the forum. It's been interesting. We've all learned from the various panelists. Maybe what I would say is to Mr. Donko, we at Impact Capital Advisors, we have the Industrial Support Fund. So like I said, it's focused on manufacturing. We might have ticket size limitations currently because we can only do up to $1 million. But that doesn't mean that we can assist. There's always the ability to do co-funding or syndicated funding. So who knows, maybe a bank might be able to throw in some $1 million for working capital, and we might be able to throw in another $1 million for equipment or marketing, some expenses that are not time-bound per se. There's always a time-bound, but within the limitations of your business. So we also welcome your members to apply, those who want to go into manufacturing, and if they're a good fit for what they do, and especially with COVID, what we call the post-COVID effects, we've come to understand the essence of ensuring that some basic medicines are manufactured locally so that whenever there's an emergency, we can all respond to that. So basically, that's what I'd like to say in conclusion.
Okay. Yeah. Okay. So I will also add my voice to thank the organizers of this forum. I think it's been very refreshing. A lot of things have been exposed to us. We at Pharma Access, our commitments to helping the health sector and also the pharmaceutical, sector, especially to improve and scale up and do more and be more efficient is unwavering. And you can see it from the various interventions and the programs that we've come up with. We are able to give loans up to $2.5 million equivalent in Ghana cedis. And depending on the purpose, it could go up to about 7-8 years, And to tell you a bit about commitment, just briefly, over the past 2 years, I think almost 60% of the loans that we have given out have all gone to the pharmaceutical sector, the pharmacists and the importers and probably 1 or 2 manufacturers. That should tell you where our attention is. So we are open for business. I'm sure our numbers have been shared. You can approach us. Our office is in East Legon. Come to us and let's discuss how we can help you scale up your businesses. Thank you.
Thank you so much. This has been an insightful and engaging discussion, and we wish to thank our resourceful panelists and all our sponsors, and most of all, our organizers for making this possible for us. There'll be a follow-up to this to create a tangible product and solution. So as you said, your number will be on the screen, and then people can contact as well. Thank you all for watching.